now we are going to discuss about one asset class which is definitely making a part of your portfolio, and that is the fixed deposits. Now interest rates are on the rise, and even if we see the fixed deposits rate, some of the banks are now actually started to offer you better FD rate of returns, and that too is rising gradually. But talking of the private banks and the NBFC space, they mostly offer you higher interest rates. So the question is that you should actually think of having better interest rates in your fixed deposits in this gradual increase in the fixed deposits that some of the banks are offering, and also in the interest rate scenario, will now banks be looking to offer you better returns once this liquidity tightening is what we are seeing in the whole of world happening? And given that they are a bit of a highly taxed versus the debt funds, to give us a clarity on all of this, we are being joined by Shweta Jain of Investography, and let's have the view on this from her. Very good evening, Shweta, and thank you so much for joining us today on ET Now. The discussion is all about FDs. At one point of time, we are seeing and reading into the headlines that the liquidity in the banking space has now fallen into deficit after 40 months. But going forward, the situation arises that the banks must be in a dire need of funds given the strong booming capex cycle, call it, or the festive season. So in this scenario, with the interest rates gradually rising, should one expect the fixed deposits rates to rise too?
Hi, Srishti. Thanks for having me. Yes, we are looking at increasing FD rates, and that's a little bit of a breather for investors because we've seen FD rates low for a long, long time now. However, the lending rates are increasing much faster than the deposit rates. And considering the liquidity constraints that banks are facing now, I think over the next couple of months, it'll be interesting to see how banks are planning to increase the FD rates to lure more investments in FDs, because that's something that I'm really looking forward to. Of course, some of the banks may attract money by providing slightly higher interest rates. I would urge investors to make sure that they're looking at the bank a little more fundamentally before we get lured into a slightly higher increase FD rates, because the simple reason being, if there is a liquidity constraint tomorrow, if it worsens for banks, especially if they're smaller and new, then they might increase the returns that you can get on your FDs, but there may be liquidity constraint later on, which you would not like to face, because trust me, FD is money that we are certain and safe and secure. So we don't want to change that perspective. So while FD interest rates are increasing, I would make sure that the banks or the NBFCs, wherever investors are putting in money, make sure that you're seeing that fundamental health before investing.
Okay, so FD rates are somewhat expected to rise in the times ahead. But Shweta, which tenure of FD would you like to tell our viewers or recommend our viewers to actually go for it? Because the interest rates are rising for sure, but like you rightly mentioned, the lending rates are have increased at a much higher pace than the FD's rate that all these banks were offering. So which tenure should one be looking at? And if I want to invest in like multiple of FDs, is there any strategy to get into that with different time tenures, and how should one strategize that?
I think that's a great question, Srishti, because we might be lured into higher rates, considering, saying, okay, it's 5 years, you get slightly higher, maybe 0.25% higher. But I think the smart strategy today would be maybe not more than 1.5 years of FDs, for 2 years worst case, because we are seeing increasing rates. So I would recommend that, you see a 6 months, 1 year, 1.5 year, 2 year, ladder your FDs according to your liquidity requirements, and make sure that you're not exposing yourself to maybe more than 2 years of tenure, because we will see higher rates in the near future, and we don't want our money to be sort of locked in during that time when we are getting better rates, right? And if we withdraw the FD, the existing FD, it may attract penalties, which we don't want to either. So I think the smarter strategy is to ladder, and maybe 6 months to 2 years max. Ideally, I would say 6 months to 18 months.
Okay, but Shweta, when we talk about FDs, there's also one facility that banks offer is that the sweep in and sweep out facility.
Yeah.
Given the rates hike scenario, will this make any change into the sweep in and sweep out? And what would you tell our viewers that is this a time to like get into this facility, or is always best to have it?
No, I think sweep in, sweep out facility is a great facility for people to have because if there is a certain amount in excess, so for example, if you want beyond say 50,000, say at any point of time 50,000 should be my in my bank, but beyond that. You could move it to an FD. That's a sweep in facility. So that happens. You are automatically getting a higher interest rate because it's then moving into an FD. But you have to be careful here because sometimes banks do have penalties if there is a sweep out before time. So you might swipe in your debit card and suddenly that FD might need to be sort of withdrawn, right? So it's a sweep out then. So if that happens, some banks, not all, may have penalty charges. Some do not have penalty charges. So you may have to sort of look into that. Also, certain types of accounts may have this. So you may want to look into that before you opt for the sweep and sweep out facility. But otherwise, it's a great facility to have because the inertia that we have in moving our money to an FD or an RD or an investment is sort of addressed with this option.
Okay, so it's great facility to have in your for your bank account. But Shweta, in this rising rate scenario, when one you are like expecting and telling a viewers that there could be a possibility where FD rates are on the rise, but when it comes to the power of allocation, so is this a good time to allocate more of your money in the FDs? Because till now what we have been seeing is that people were very much interested into the stock markets. They were actually pulling out money from the FDs which were giving anywhere between 4 or 5% and putting in the stock markets in expectation of a higher interest and higher returns. But now when the markets are turning quite much volatile, so getting back or shifting back to FDs, is that a good idea?
See, we are seeing this move already happen, right? So I don't think it's a great idea to do for a simple reason, right? FTs for me is a short-term sort of liquidity requirement product. It will not give me long-term growth against inflation and taxes over time, like a 3-year, 5-year, 10-year period. So for that, if people are just panicking and putting money in this for the time being is okay. So shorter term FD, 6 months, 3 months, 6 months, 1 year, it's fine. But like I said, for me, it's not a long-term product. Like for example, people get attracted with the 5-year FD, saying it has tax benefits, right? So I'm not a fan of that product again. So I would say for short-term requirements, till you don't know where you want to allocate, that's fine that you keep it in a 3-month FD and figure out, what your choices are or figure out where the economy is going, where the world is going. So that's fine. But over a long term, I wouldn't recommend that you keep your money in FDs.
Okay, so that's the recommendation coming in. But Shweta, now it's time to hit some of the queries that our viewers have sent in and would like to have your answers to the same. My first question is from Venkatesh Sayadri. He says that he's 47 and have worked in, and is working in a private company with 3 dependents right now. He has 62 lakhs in shares and 60 lakhs in mutual funds and 55 lakhs in PPF. This is all his family income put together, and along with that, there's 10 lakhs in FDs currently. He says that he has not taken any individual health or life insurance plan as of now, but his wife and he himself is covered under the company policy. So, is this essential to buy an insurance right now, or and he plans to retire about 5 years from now?
So I think yes, he should definitely have insurance from the portfolio that I'm seeing. It's pretty well diversified, so that's fine. Just one thing I'd like to highlight here: he has 10 lakhs in FD, so FDs are insured up to 5 lakhs. A lot of people didn't know this before, but of course, in the last 2 years, there is quite a bit of awareness about this. But 5 lakhs of FDs is covered in insurance. Beyond that, it is not. So I would make sure that he is aware about it. Insurance, I think for the next 5 years, definitely he should take life insurance. So he could take one for, say, for the next 10 years. And health insurance is something that he should have for his family, not just for himself and his wife. He should also check whether health insurance that he has from his company, whether it's portable beyond 5 years. So, right, if he can port it once he's retired from the company, then that makes sense. If it's not portable, if the company does not allow it, then he should take his health insurance cover now rather than later, because if he does have existing illnesses, there'll be a waiting period to cover that. So, I think that is needed on an urgent basis.
So that's the answer for Mr. Venkatesh. But another query we have, Shweta, is from Amit Trivedi. He says that he's invested into total 21,000 in mutual funds for various goals. And he just wants that if you can check his portfolio right now and suggest him in a proper fashion. Where first one is Kotak's Tax Saver, where he invests around 5,000. Along with that, it's Kotak Flexi Cap Fund, where he invests 3,300. Kotak Small Cap Fund is another 5,000 into this pocket. PGMIM Mid Cap Opportunities 5,000. Mirai Asset Emerging Blue Chip 3,000 and Kotak Small Cap Fund 5,000. So a whole host of investments that he has made across the different caps and categories. He's investing around 21,000 per month. What's your view on his portfolio and how are you liking it?
So I think it's a quite a decent portfolio, especially if it's doing himself. I would just recommend that he doesn't spread it much more than this. All of the segments are covered, like you rightly mentioned. All of the categories are covered. But I would make sure that there is no concentration risk. So even between the categories, if there are similar funds, there's not overexposure to certain stocks, and making sure that the volatility is sort of lesser. What I would also recommend that he looks at sort of passive funds for any incremental funds that he has. I think that would cut down costs to quite a bit. Also, would cut down the volatility to a little extent. So I would urge him to look at passive funds as well.
Okay, that's the answer coming in for our second guest. The third query we have, Shweta, is from Saurabh Sharma. He says that I have ICICI regular mutual fund and it is into ICICI small cap fund, ICICI large cap and multi cap fund. For 15 years he has invested, and he wants to know that how much return this can give in the next 15 years. Currently he's investing around 10,000 per month.
So 10,000 per month, if you take around 10 to 12% on an annual basis, would give him about 50 lakhs at the end of it. But it won't be linear, of course. So there will be times of underperformance, there'll be times of negative returns, but he'll have to wait it through. I would urge him to keep increasing his SIP every year. So he could start off with like a target to see, where he needs to get to, because right now I told him on a calculation basis that he could reach 50 lakhs. But if his target was say 60 lakhs or 75 lakhs or whatever, he could then get the required motivation to increase savings. If he does have the potential to increase his savings, then he could do that. So I would urge him to keep a target and then sort of invest. And I would also recommend that he chooses funds from other fund houses as well. I'm not a fan of 100% to one fund house, however good the fund house is. ICICI is a great fund house, but I would urge him to diversify.
Okay, so there's a bit of a need to diversify, and that's the answer coming in for Saurabh. But with this, we'll let you go on that. Shweta, thank you so much for joining us today on ET Now and helping with your take, what to expect when it comes to the fixed deposits.